In trading, knowledge is power, and lack of knowledge in what you're doing can be costly, very costly. So you need a solid foundation of quality market education. Whether you're new to trading or a seasoned veteran looking to add advanced strategies to your arsenal, there's always something to learn and something to improve on. And now you can access the same knowledge that professional traders receive with Market Rebellion's Trading Education. I'm Bill Johnson, Head of Options Education here at Market Rebellion, and we've assembled a comprehensive curriculum based on decades of real trading experience, covering everything you need to know about trading options from beginner to advanced. We go way beyond the nuts and bolts of options theory to teach you how to apply specific trading strategies and the techniques needed to adapt your trades when markets shift. Regardless of your goals, you'll gain access to the education you need with easy-to-consume lessons so you can learn to trade with confidence, enhance your knowledge, and master the practical skills required for market success. So please join us for in-depth trading education only from Market Rebellion.
And welcome back to all of our market rebels and YouTubers out there. And it's that time again, Stu, 4 p.m. Eastern on Thursday, and we're here for Coach's Corner. And for anybody who's new, first of all, it's great having you here. But the idea is that we want to help traders out there, especially who are new to options, to give you a different perspective, mostly from our world-class coaches that we often cycle through here at Market Rebellion. But Stu is always with us, 29 years as a market maker specialist at the Philex. So
That's
Stu,
me. Yep.
Great having you back, man.
Hey, thanks for having me, Bill.
Of course.
Always a pleasure.
What happened with the markets today? I think we were kind of unchanged. I didn't see it going into the close. I think the Qs were up, what, 1% or so?
Q's up a little, tiny bit over 1%.
Up a stick, yeah.
The Russell down less than 1%. Everything else pretty basically unchanged here.
Yeah, so I know during Q&A, we saw that it was a piercing pattern on the Qs, and now it ended up being an engulfing pattern. So we'll have to see if that's going to change things for tomorrow. But for today, what we wanted to do is to help people to make better decisions. That's kind of always our theme. It's going to get, I don't want to say tricky, but there's an ever so slight touch of math. But remember, don't let that bother you. It's the concept that matters. And we want to point out some things that you're just probably not aware of.
Yeah, don't even worry about the math.
Yeah, but we like to show it just to give you some of the insights about what's making it tick. So as always, let's start off with Chalk Talk. This is our little bit of a, what do you call it, challenge question, I guess would be a good name for it. And we want everybody to think about this, jot down an answer. And then at the end of the program, we're going to cover the answers. Mm-hmm. So here you go. Which poses a bigger risk, delta or gamma? Now, these are not the only two Greeks, but these are two of the more common ones that are widely watched. And if somebody came up to you and said, which one poses a bigger risk, how would you answer that and why?
You want me to answer that, or you want to?
No, I don't want you. I know you know the answer. I don't want you to say anything until we get to the end.
You know what my answer is going to be, right? It depends. But
that's always the throwback answer for a professional options trader, because it's true. It does depend on on different factors, and that's a little bit of a clue of how we're going to answer it, but we're going to show you about some of these if, ands, and buts.
Yeah,
so
this is going to be big.
Yeah, it'll be very good. So let's talk about that. Some of our Greeks, delta and gamma, and what we want to look at today is where do option gains and losses come from? Now, I know you talk about this all the time, Stu, to your clients and during Q&A, but sometimes people just say, oh, the stock is up and my option made whatever, X amount of dollars, or I'm up $2,000. Well, that's great, but what were the sources of those profits? And too many times people go, oh, I don't know, it doesn't matter. Well, yeah, it does matter. Because if you can't account where those profits came from, even though it might be a profit, it just shows that you're trading blind.
How about this? If you can't account for where it's coming from, you can't possibly account for where it might go.
I love that.
Especially if you're starting at zero and now all of a sudden you're down.
You're down. You need to be able to account where those profits and losses come from. Now, when we're trading shares of stock, it's easy. If you have 100 shares of stock, you've got 100 deltas always. So if its stock rises a buck, you're up 100. Goes up $3, you're up 300. Same thing on the way down. That's easy to account for. But as we're going to find out, it's not so easy with the options.
Yeah, another way to say that is if you have 100 shares of XYZ stock and it's $50, it's 100 shares of XYZ stock. But if the stock is $150, it's still 100 shares. And that's never going to change. It could be $2, $20, $50, $100, $500, $1,000 stock. It's always going to be that 100 shares. But as opposed to the options world is where it has a little curvature to it, sometimes a lot of curvature, and that 50 shares, 100 shares, whatever delta you have, that's changing. That's not a constant. The only thing constant about it is that it's changing.
It's always changing. That's probably a good underlying theme for today's presentation, that it's always in motion. And too many times people say, oh, I've got a certain delta, and it stays at delta until the stock makes, let's say, $1 move, and then things change. That's not true. It is always changing. So we're going to find out what some of the repercussions of that happen to be and why you might end up with some unwanted or surprising losses. Mm-hmm. So let's start off with a quick review of delta. Remember, delta is one of our 5 main Greeks, and it shows different ways we can look at it, but shows the percentage change of your options price for the next dollar move in the stock. That's super important. It is not for $4 and $5 moves down the road, 6 or 7, or for next week. We are talking about an immediate move. Now, we can also define it as the actual dollar amount your option picks up from a favorable $1 move in the stock. Mm-hmm. Just a different way of looking at it.
Same thing.
Just kind of assuming that it moves $1. But, what if it moves 50 cents or 20 cents? That's when you'll want to really focus on the percentage change. Yeah. So, for example, if let's say we have a $100 call trading for 3, you look at your broker's platform and it has a delta of 60. All right. So what happens if the stock price changes by $1? So we see this on our platform. Stock goes up $1 to 101. What's going to happen? We're going to pick up 60% of that $1 change. Or second definition said it's the dollar change, 60 cents per $1 move. So we would expect that option should be trading for 360. Now, again, this is assuming an immediate move, not next week. And possibly even 15 minutes from now, this might not be true.
It's right now. It's
right now. It is constantly changing. But right now, that would be the relationship. If the stock falls $1, then the opposite happens. We're going to lose 60% of that dollar change. We would expect that option to be trading for 3 minus 60 cents or 240.
Yeah, notice it's 60 cents. It's up and down. It's both
up and down, but for the next move.
Whether you long it, whether you're short it, whether you're this, that, or the other, it doesn't matter. It's the change of the option. It's not dependent on what you have. That's another thing. People always say to me, well, am I long or am I shorted? It doesn't matter. It's a change in the
options
price. Yes.
Yep. Now, we have a positive number here, and that's why we have a direct relationship or a positive relationship, meaning that if the stock price goes up, our call goes up. That's why I drew green arrows. Up is associated with up, and down is associated with down. When we get to put options, the concept is exactly the same, but it's in the opposite direction. And there's a little mathematical, little side note, little connection here. If the call has a delta of 60, the corresponding put, meaning it's the same strike put, same expiration, is going to add up to 100 deltas, not counting the minus sign. So that put would have a minus 40 delta.
You didn't tell me we were going to be talking about put call parity today, Bill.
We're not really. But it is. That's a variation of it. Yep, it absolutely is. These are all things we talk about in Q&A. But super, super important for people to understand. So let's take a look at how it affects the puts. Stock goes up $1. What happens now? Now we lose 40 cents. So we would expect that option to be trading for about $2.60. Notice
follow the connection all along here. Remember, Bill said it was 60 cents. Well, 60 delta on the call. Well, that means it's a 40 delta on the put. So now we have to make the adjustment for a $1 move, by 40 cents. And that's how you get from 3 to 260.
And we can see I've got a green arrow, stock up, but call option down. That's what the minus sign in the delta is telling us. Conversely, if the stock falls and that becomes a good thing, we would expect that put would be trading for about 340.
40 cents.
Just notice that green arrows are matched with reds, whereas with the positive delta, it's green for green and red for red. But the concept is exactly the same. All right, so that's delta. And as we're going to find out, this is where most traders, this is where they focus. Stock goes up, here's how my option is going to change. And they don't account for gamma. They think that gamma comes into play after that $1 move, and they'll say, okay, now I get a new delta. And that is absolutely not true. It is both of them are changing.
Or they don't even account for it at all.
Or that's exactly right. Yeah. So let's look at a quick definition of gamma just so people can follow along. This shows how much your delta will change for there's that word again, the next dollar change in the stock's price. Sometimes this is called the delta of the delta because it's exactly the same concept, but instead of telling you by how much your option's price will change, it's telling you how much your delta will change. This is the only Greek that doesn't measure a change in your option's price. It's at least of the main Greeks. It's showing you a change in your option's delta. So let's go back to...
All the Greeks actually tell you something. They tell you how much of something, right? They
a change of something, right?
A change of something. That it's like your dashboard on a car. It's giving you it's telling you what the changes are. It's telling you how fast you're going, what's the oil pressure, all that kind of neat stuff. It's describing the changes that are occurring.
Right. So let's see how gamma works. Let's show them here. This Stu here. We've got our $100 call for 3, and let's say that your broker's platform shows a delta of 50, and let's say that it shows a gamma of 10. So last time we just looked at delta. Now we're going to look at gamma as well. Mm-hmm. What this means that if the stock rises $1, the delta is going. We said that it's going to be changing. Well, what's it going to change to? It's going to go from 50 to 60. And this increase, there's your gamma. Mm-hmm. It's telling us we are going to pick up 10 deltas.
Does it go from 50 to 60, Bill?
It would. That would in total. But again, here's where people get tripped up. They think that it stays at delta 50 for the entire dollar move, and then all at one shot changes to 60. And that's why they end up making these mistakes with these calculations. We're going to show you how to correct for that. So if you like this kind of stuff, if you're brand new, please visit us at marketrebellion.com/get started. Lots of great things, free videos, all kinds of educational materials to help you get started, all absolutely free. All right, so now let's take a look at combining delta and gamma. We looked at them independently. Let's put them together. Let's put our stock at $100 call for $3, delta 50, gamma 10. If the stock rises $1, what's the new option price?
And let me jump in here and say, sure. When I ask this question,
I can imagine
in my coaching sessions, I would say 98% of the time, the client is unable to answer.
Oh, I thought you were going to say they were just going to account for delta.
It's not even that.
Not even that.
The stock is 100. Now the stock is 105. This is what you have. The 100. What's the new price? Well, let's see. Am I long it? Am I short it? What's the expiration? How long have you? All kinds of questions.
Yeah.
And just unable to make the connection about where we are to where we're going And that
Right.
is really important. I mean, you would never.
That's what trading's all about.
That's what trading is all
We
about.
have to
You're
know
trying to
we're
get from
moving from point A to point B. How is this options price going to change?
Yeah.
And if you can't account for that, you're flying blind. And obviously, that is not a good way to trade.
No, you just let the market tell you where you end up. And by that time, there's a pretty good chance it's going to be too late. And
That's
now
right.
you're saying, oh, how can I fix this trade?
Yep. So here's what most people, this is what I thought you were going to say. Most people would say, well, the call's at 3. I've got a delta 50, stock rises a buck. That option should be trading for 350. That is the big misperception. And again, that's probably the big concept that we want you to get from this presentation. Traders think that it's delta 50 for the entire dollar move, and then it changes to 60, and then we're delta 60 for the entire move. It is not. It's constantly changing.
Yeah.
So here's the way that we answer it. Here's our delta 50. Let's say this is a $1 change in the stock price. As that stock price is changing, that delta is moving from 50 to 60. Notice it does not all of a sudden jump to 60. It is always changing. So one thing that you can think of, I often make an analogy of this, Stu, like driving a car. Let's say that you're driving at 50 miles per hour, and this is a 1 hour. This green arrow is 1 hour. Well, you would go 50 miles. But what if you were accelerating?
Wait, hold on. What kind of car are we driving?
Exactly. We get that a lot in the afternoon. It doesn't matter. But what if you were accelerating at 10 miles per hour? That's really what gamma is saying. We're going to go from 50 to 60. That's an acceleration of 10 miles per hour. Well, if you think about it now, just to put it in some discrete, I guess some little increments that people could follow. Let's say that every minute you increase by 1 mile per hour. So you're doing 50, then after 1 minute, you're doing 51. After 2 minutes, you're doing 52. And on that 60th minute, you are now doing 60. Well, the question is, did you still go 50 miles? No, because you weren't doing 50 the entire hour.
And how about this question? Did you go 60 miles?
That was exactly. No, you didn't, because you were only, the very second you hit 60, you didn't really travel any distance at 60. That's just what your speedometer read at the end of the hour.
At that time, right.
So, but the thing that I want you to see is that it's always changing. You should realize you should be going further than 50 miles. And in exactly the same way, for exactly the same reasons, you should have more than 50 deltas in this period through here. So one thing we can look at, I'm going to show you a couple of ways to figure it out. We could say, well, if you start at 50 and you end at 60, on average, you've got 55 deltas. So now I could just pretend that we moved $1, but I'm going to pretend that the delta is 55, not 50. Now, there's another way we can do it. This is where we're going to get into that little bit of math.
And that's a really quick, that's a real quick way to do it. It's just an average. It'll get you in the ballpark. You don't have to have it perfect. It's really easy, simple, to the point, get it done, move on.
And certainly better than saying it's just going to be delta that's going to affect it. Yeah. Especially as you're going to find out when you get into large gamma positions, naked options, short options. That's where you can really get the unwanted surprises. So here's the information that we looked at. Stock rises $1. All right, how can we break this down? So professional traders know this. We call this a decomposition of profits or losses. And in future classes, we'll start involving theta and vega and other things, but we're just going to do delta gamma. One thing I'm going to look at is to say that we got a $1 increase with a delta of 50. So that's going to account for 50 cents of a change in my options price. But now how does gamma affect it? Gamma, here's the formula. Now, don't panic if you don't understand the math. It's okay. It's just to show you the concept of why it can be tricky. You're going to take half a gamma, 0.10 divided by 2, and we're going to multiply it by the change in the stock price squared. This is why it gets very tricky with gamma. That little exponent, that squared, means it's rising exponentially. So 1 squared just means 1 times 1 is 1. So we can kind of forget this. 0.10 divided by 2 is 0.05. So this option should pick up 50 cents plus 5 cents, the $100 call should gain 55 cents. Isn't that what we figured out on the previous slide? We said just pretend that you have a 55 delta.
I think that was the same thing.
Yeah, you didn't have 50 deltas, you didn't have 60, you kind of had on average 55. This is a little bit of what's going on, but people really miss this part about this little squared term. And this is what causes some real problems, as we'll find out.
Yeah. It's
So
just
let's try it again.
It's just the big picture is, guys, it's just an average. It's
Just an average. Yep. So let's look at the stock rises $2. Now, again, all of your Greeks should only be used for very small changes, not a full day's time for theta, but an hour, technically speaking, or minutes. We're talking about very small changes, not a full dollar change in the stock price, but fractions of a penny, if you want to get really technical. But for practical purposes, we can get a really good estimate by these formulas that we're showing you. So let's go back to our basic information and say that the stock rises $2 now. All right. So if it rises $2, what's the new options price? Most traders are going to guess what? 50 delta times $2 would be $1. And they'll say that the option is going to pick up $1 and go from 3 to 4. But that's not true. We need to get better at our estimates. So here's what's going to happen. We're going to start off with a delta of 50. The first dollar change, we are going to end up with a delta 60. And on the second dollar change, we will end up at delta 70. What's the average delta now? Right there in the center is delta 60. So we could just pretend that we have delta 60, not delta 50, not delta 70. We should pretend that we have delta 60 for $2, which is what? $1.20. So the option should gain about $1.20 and be trading for $4.20, not for 4. Now, again, not a huge difference, but we're going to find out this is going to accelerate. All right, so that's kind of a way to understand what's happening. Now, let's do it for $3. Stock rises, stock rises $2. This is our second way of looking at the formula. So the stock rises $2. We say $2 times delta 50, we pick up a full dollar from delta. But now check out gamma. Half of gamma is 0.10 divided by 2, but now it was a $2 change in the stock's price squared. Now we're multiplying by 4.
Right, 5 times 4, 20 cents.
The first time we multiplied by 1, on that second dollar move, we multiply by 4. On that third dollar move, we're going to multiply by 9. See, it's accelerated. This is the part that catches people. So now if we say it picks up $1 from delta and 20 cents from gamma, the $100 call gains $1.20. And isn't that what we came up with on the previous slide? Delta 60 times 2 is $1.20. All right, so it's going to start getting harder to track because of that exponent, though, as we go on. But this is the idea behind it.
Look at these numbers. It's a $3 option, and it's up $1.20. That's a big piece.
It's a big change.
That's huge, especially if you're looking at percentages. I mean, that is giant. That's
yes, it is. Yep. And so now the thing is, what I said before is you have to be careful about the using large ranges. Like $3 is probably too big of a range, although we can still get fairly good estimates. So why is that? Well, this is also where you have to understand your options theory. It depends on your time frame. If you have a short dated option, let's say this is a $100 call with 5 days to expiration. Look at that gamma. It's an at the money option. These babies will go to infinity as you get closer to expiration. Now that might sound like a big dangerous thing, but remember, after possibly even a 50-cent move in the stock, it's going to be gamma 0.
Or something small relative to it.
Yeah, you could see it just goes right off a cliff. Yeah. But if you have a longer dated option, look at how flat this black part of the curve is down here. Yeah, you could get a really good estimate, potentially over $4 or $5 because it's fairly flat. Mm-hmm. Again, this is where you have to understand, like Stu said, it depends. And as a professional trader, if you're trading a 3-day option or a 1-day option, it's a whole different ball game than if it's 9 months or a year or something longer.
And this kind of theory also applies to prices of the stock as well. See, it's a $1 move, but a $1 move on a $100 stock is a really big difference between a $1 move on a $5 on a $500 stock.
That's right.
So that change in delta is going to be much smaller on that bigger, your gamma number is going to be much smaller on that bigger dollar stock. It's not going to have as much of a dramatic effect.
Correct.
So, you gotta know that going in. You're gonna, if you don't know this, you're just flying blind, like Bill said. It's just not gonna be good.
And this is one of the things where, like, a lot of times in certain aspects of trading, you might figure it out on your own just from trial and error. This is one that you're going to really struggle with until you understand what makes it tick. So let's take a look at some examples. And before we do, please, if you are brand new to options or maybe just not getting the results that you had hoped for, please check out marketrebellion.com/get started. Lots of great introductory videos on there. But we just want to make sure that people understand how to make decisions. This whole game is won by understanding how to hedge roll more through time, as opposed to just saying, here's where I think the market's going. I mean, that's fine if you have an opinion, you buy a call option or a put option, but how are you going to manage that over time? And so again, if you're not getting those results, or if you're brand new, please check that out. It'll really get you on a good start. Okay, so let's take a look at some examples. Let's put this to the test, Stu.
Yeah, this is going to be great. I can feel it.
I haven't checked these numbers yet, but let's give it a shot. So we've got a pricing model, and a pricing model, for those who may not know, is a theoretical pricing model showing us based on these inputs: stock price, strike price, number of days to expiration, volatility, interest rates I've left off, and dividends I've left off. It's telling you theoretically what that option price should be. It's what's called
real quick here. People should be able to look at this. I think at least people should be able to look at this and glean several items. Number one, if you take a look at the delta, first of all, if you're looking at the strike price and the stock price, they are the same, which means that the strike price is actually the at the money option. Well, in this case, because it's so quick dated, 10 days to expiration, they are going to be the same. They're going to be the same. And that means it's about a 50 delta. And if you look over on the call and the put side on the values, you're going to see that the deltas are pretty much the same. Less than one is the same. So they are the same. And you need to be able to see that. You need to be able to see that, because you can help to make decisions about what kind of exposure that you want. Do I want the at the money? Do I want the in the money? It helps to answer the question of what's going to happen. Take a look at your theta. Your theta is the same. Your theta is the same, unless there's some sort of a pump or skew in one side or the other, which generally there will not be. Sometimes you'll see it due to a cost of carry or a dividend, but otherwise you're not really going to see that unless there's a reason for it, like a hard to borrow. But you can see that those numbers are the same as well. And you need to, and same with the Vega. It's all the same. And you need to ask yourself why. See, that's the key to understanding the theory. Why are they the same? What does it mean? What do they mean? And how can I apply it? You can even look at the value of the call and the put. They're the same as well. If you think about it, it's really a 50-50 shot, isn't it? Right off of the middle. So they should be the same.
Yep. So also, as we talked about, delta 50, if we forget about the minus sign, if we add them up, we get exactly one. And that's because a long call and a short put would give us delta 1. That would be a stock position. So let's go ahead and put some of these to the test here. We've got the stock at 100, strike at 100. And let's say that the stock rises $1. All right. So for all of you out there in YouTube land, put yourself to the test. What would you estimate the new call price to be? Now, again, most people would say we're going to pick up roughly 50 cents and be at $1.82.
I think most people would say it's going to be higher. Leave it at that.
Let's just hope they at least get that part right.
Okay.
But remember, we have a $1 change times a delta of 50 is going to account for 50 cents. That's true. But what about gamma? Gamma, we can say, is roughly 0.12 divided by 2. Change in the stock's price squared is 1, right? 1 squared is just 1. So this is going to be about 6 cents. So we shouldn't expect the option to pick up 50 cents, but more like 56. And so we would expect that call to be trading for about $1.88. I'm just going to add 56 cents to this number. So let's do it. Let's flip this over. We're going to change this number to $1.
And if you look real quick at that, hold on, go back one, will you, Bill, just for a second? And if you look at the gamma number 12, you're going to get a change. That's describing the change in delta, right? So 12 on top of 50 is, because it's the change in delta, is 50 to 62, right? That's 12, and half of that is 6. So 56 cents. There you go.
Yep. So we should also see the new delta go to, now the reason it didn't go to 56 is because of gamma. See, this is the acceleration part that we're talking about. But anyway, here's the stock price change to 101, and there's the $1.88 that we came up with. See, now there's no surprises. So now let's say that the stock goes up $2. We're going to reset the clock. Now remember, technically, we really shouldn't be looking at stock prices over a $2 range. Technically shouldn't be looking at them over a $1 range. But we're going to do it just to show that we can at least get reasonably close.
Yeah.
So the stock price rises $2. What's the change in your options price? I look at delta of a half times 2 is $1. So I know I'm going to pick up at least $1.
Pretty easy. Yep.
What about gamma? So I'm just going to look at this and say half of that is what? 6 cents. It's a $2 change squared times 4. Excuse me. So that should be 24 cents. 6 cents times 4.
Mm-hmm.
See, last time it was 6 cents times 1. Now it's 6 cents times 4. It's compounding. We're going to pick up about $1.24. Well, that's a very big difference, especially on a short option, and especially if you're not accounting for it. So we would expect that this option should pick up $1.24 on top of $1.32 and trade for about $2.56. So let's try it. Let's change this number over here to 102, and now we get $2.56. Should we push the limits a little bit more? Let's try and do a $3 change. So here we are on our trading platform. I'm looking at my option. I say, okay, first thing is delta of a half times 3. The option is going to pick up $1.50 minimum. But now I'm going to take half of gamma, 6 times what? $3 change squared times 9. And so that's going to give us 54 cents. See, now it's accounting for roughly a quarter of that change. And if you've got a short option and you're not accounting for that, you are going to get hit with very unwanted surprises. Or in a diagonal spread where that long one might have a very low gamma and the short one might have a massive gamma. This is where a lot of the mistakes creep into. So we should expect this option to pick up about 204, should be trading for about 336. So let's change this to 103, and we should see this go to roughly 336. So there's 103. See, now we've overshot it. What happened? Still not a bad estimate, but why did we overshoot it? Because our gamma curve is starting to look at our gamma. See, we're down to 0.08. But it really shows how everything is constantly moving. Everything's in motion. So if you get nothing else from it, you don't go from delta 50 and stay at delta 50, and then bam, hit delta 60. It is a constantly changing evolution. Everything is moving all of the time. So here's a little table to kind of put the icing on the cake here, Stu. Here's a gamma of 10 that we looked at. And these are the numbers that we just saw. Okay, so if we have, we can see that for a $1 change, gamma accounts for 9% of that option's price change. For a $2 change, it accounts for 17%. And for a $3 change, it accounts for 23%. So what I'm looking at is to say, well, if 5 cents comes from gamma and 50 cents comes from delta, 55 total, 5 cents out of the 55 is 9%. And now 20 cents from gamma over $1.20 total is 17%, and so on. But look what happens when we go to gamma 40. And this is going to happen as you start going closer to expiration for at the money. Now it's accounting for 29% on a $1 move, 44% on a $2 move, and 55% on a $3 move. And if you're not aware of this, this is where people get stuck. So what are the things that we want people to think about here, Stu? What are a couple of little golden tidbits we can leave people with? Uh-oh. Stu, I didn't even see. He did drop off out here. All right, well, I'll go ahead and answer. The things that I think you should consider is to recognize that It's an ever changing process. It's always in motion. And so if you have a vertical spread and maybe both options are out of the money on a call spread and the stock starts going up and you're going, yeah, my vertical spread's going up. It's going up. It's going higher. What should you start to expect? That gamma on that long is going to zero and the gamma on the short is starting to get maximized. Eventually the value of that vertical spread is going to flip in the short run. So what does that mean? You could see stock price up, your vertical spread's up. Stock price up, your vertical spread's up. Next day, stock price is up and the value of your vertical spread is down. And sometimes traders panic and they go, it's the market makers trying to rip me off. Let me close it. And they don't realize that's all going to go out because of theta. But what we're trying to show you is that this is why it's so important to understand how the option prices behave through time. That's what allows you to make the decisions about when to hedge, roll, and morph. So let's take a look at our Chalk Talk, and then we'll wrap things up. So the Chalk Talk question was, which poses a bigger risk, delta or gamma? Well, like Stu said, it's a little bit of a trick question because it does depend. In the absolute sense, delta is your biggest risk because deltas can keep going on forever. Let's say that you've got a short $100 call. Not that we ever recommend that, but just for the example, if the stock goes up to 101, 102, 110, 120, it can go on forever.
I'm back, man. I had to go down to the corner store and pay the bill.
I gotcha. So we're just answering the Chalk Talk here. So the delta in the extreme case is your biggest risk because there's really no theoretical limit on how high a stock can go, and for the most part, how low. I know a lot of people, I say, hey, wait a minute, stock can only go down to zero. It's limited. Yeah, but how often does that happen during the life of an option? There's usually nothing in the way of that option strategy to block it. So that's why professional traders still consider it, reasonably speaking, an unlimited risk in both directions. But for the short term, gamma is the one that can get you, because normally we talk about risk as being price changes. Hey, my option was trading for $1.
It's more like the short run of the stock.
Exactly.
It may or may not be a short term. It's more of the run of the stock. While the delta can, keep going, like Bill said, the gamma eventually is going to run out, right? And
yes,
if it's a shorter dated option, it's going to be sooner rather than later. But eventually, the option will go to a 0 delta, or the option will go to 100 delta, at which point the absolute number of the gamma is going to be 0.
It will be 0.
But that, on a longer dated option that has more extrinsic value, that's going to take a much more of a bigger move.
Right.
So it's both. The answer is both.
Yep. So your gamma in the short run, if you're looking at a $3 call and it might drop to $2 or $2.20 on a very small stock price move, that's not delta, that's gamma.
Mm-hmm.
So you could make an argument that gamma is the bigger risk of the two if you're talking about a fairly short time, a short window, and especially if it's an at-the-money short-term option. Because as we showed before, this is when your gammas can go through the roof. And this is where your gamma is going to play a much bigger role than here for the longer dated.
Now, the other side of that conversation is it also really helps you out if you're wrong.
Oh, yeah.
Right? It really helps you out if you're wrong. You got that $3 or $2 option and the stock's going the wrong way. All of a sudden it's not 50 delta anymore. Now all of a sudden it's $40, $30, $20.
That's why we pay for long gamma. Everybody who bangs on about positive theta and selling options is missing the whole benefit of positive gamma.
Yeah, it's a great hedge. It's an unbelievable hedge.
It's an unbelievable hedge, and that's where the value is. That's why you have to pay for it.
That's right.
It's true for a short option, you get positive theta, but you've also got negative gamma, negative vega.
Mm-hmm.
And those are the things that can come back to haunt you.
Yep.
So we hope that kind of gives you a little bit of a glimpse into why we tell traders that the education is so important to succeed with options. And so I hope that gave you everybody out there on YouTube, some things to think about. And any final closing thoughts, Stu?
As usual, my friend, know your risk.
Know your risk.
Be able to answer the question of what will this position, whether it's just a plain vanilla call or put, or whether it's some multi-leg strategy. Know where the numbers are going to look like out into the future. And whether the
Correct.
future means future in time, whether the future means future in stock price change, whether the future even means changes in interest rate, which we don't really talk about too much, but these days we have to.
We have to.
Because we're not really in a zero interest rate environment anymore.
Or even necessarily a steady one, right?
A steady one, exactly, right? We have volatility in the interest rate market. So yeah, just have an idea where you're going to wind up. What you know where you are at point A, but where will you wind up with point B? If you have a stock that you buy at $100, you're very well going to say to yourself, well, you know, if it goes to 110, I'm going to make $1,000 if I have 100 shares. Well, how can you do that with the option price, right? You got to have an idea of where you're going so you can kind of figure out how do you want to get there, right? What road am I going to take to get from point A to point B? And this is the kind of thing that's really going to help you to answer that question.
Yep. Well said. So I hope that gave you some things to think about. And again, if you do have questions with that, please check us out, marketrebellion.com/get started. And with that, we want to wish everybody a great rest of the week. Hopefully we get a little turnaround in the cues and the markets here, at least assuming that you're on the long side. And have a great weekend, and we'll look for you next Thursday. We'll see you then.
See you later.